Learning objective 10.5, evaluate a company's performance using new ratios. In this example here, we have the ROE, which is the return on equity. The ROE is computed by taking the ROA times the leverage ratio. The ROA, the return on assets, is computed by taking the net profit margin ratio multiplied by asset turnover rate. Well, these are still ratios, so how do we get these? So net profit margin ratio is determined by taking net income divided by net sales, and the asset turnover ratio is net sales divided by average total assets. The leverage ratio is determined by taking average total assets divided by average common stockholders' equity. Now, this is a long way to go about it, but in the end, the ROE is actually equal to the net income divided by the average stockholders' equity. Well, you can see because the net sales here cancel out, average total assets cancel out here. So what's remaining is net income divided by average common stockholders' equity. Net income divided by average stockholders' equity. Plug in some numbers to see how this works. In the examples here, we have net income of, and I'm just going to refer to them as they are, $7,957. They're probably in millions or billions or whatever it is, but $7,957 net income divided by net sales of $94,595. That actually gives you a profit margin ratio of 8.412%. You then have the asset turnover rate, which is net sales of $94,595 divided by the average total assets of $42,470. So we take that computation, we end up with 2.227. So we really want to compute the ROA, the return on assets. We simply take this multiplied by this, and we'll come up with 18.73%. We then can look at the leverage ratio by taking average total assets, which in this case is $42,470, which was the same that was used here, divided by average common stockholders' equity of $53.25. And that results in 7.9756. And that becomes the leverage ratio. If we take this multiplied by that, multiplied by this, we'll end up with 149.4%. Or we could have simply just taken the net income of 7,957 and divided it by the average common stockholders' equity of 53.25, because this canceled out here, this, and this canceled out that. What's remaining? This divided by that. That's 7,957 divided by 5325, and that will give you 149.4%. So we can look at the ROE, the return on equity, and really by itself doesn't tell us a whole lot. But what we like to do is compare it to prior years. So in 2016, we plot out all these ratios, the ones we just computed down here. We plot them all out, and then we can plot out 15, 14, and then even throw another company, Lowe's company, and see what their numbers look like. So net profit margin looks like it's heading up. That's a good news, and compared to Lowe's is higher. Asset turnover rate, 1.88. Again, Home Depot's is up, and compared to Lowe's, it's better. The leverage ratio, 3.57 at Lowe's, and this seems to be going up as well, 7.9756. The leverage ratio is a good thing as it improves or goes higher. And then the return on equity, and this definitely shows how Home Depot has been increasing over the years and definitely better than Lowe's in 2016. Another common computation we like to look at is the earnings per share. How much money is being generated in terms of income relative to the amount of shares that are outstanding. The way we compute this is we take the net income minus preferred dividends, and we divide it by the weighted average number of shares of common stock outstanding. We can look at earnings per share, an actual example of a computation. Consider the EPS calculation of Home Depot. Net income for 2016 was $7,957,000,000. So we look at this $7,957,000,000 as being available as income available to the common stock shareholders, but not preferred stock, just available for common stock. If we look at the amount of outstanding shares, it appears we had 1,203,000,000 shares of stock outstanding, plus 53 million shares the company repurchased during the year. So we had a total amount of 1,229,000,000 shares outstanding. So we can use this as a basis for computing the earnings per share, which, as the previous example showed, net income minus preferred dividends. There are no preferred dividends, so that will be 0. So we simply take the net income and divide it by the shares outstanding, 7,957, which was provided, divided by 1,229, which was also provided, or we could compute. So we have weighted average number of shares, basic of 1,229,000,000, and earnings per share of computed to be $6.47. And that is computed by taking 7,957,000,000 divided by 1,229,000,000 shares. Now, if we had preferred stock, we would have to discount or subtract the amount that could be paid out for preferred stock, subtract that from earnings. So in this case, suppose Home Depot has 5 million shares of $100 par value, 5% preferred stock outstanding. So we're going to take the 5 million and multiply it by $100 per share. Suppose Home Depot has 5 million shares of $100 par value, 5% preferred stock outstanding. The stockholders would be entitled to receive a $5 dividend per share. The amount of net income attributable to preferred stock would be $25 million. So here's what we're going to be doing. We're going to be subtracting from total income the amount attributable to preferred stock, which means we're going to take the previous amount of $7,957,000,000, that's the net income, and we're going to subtract from that 25 million for the preferred stocks. And then we're going to take the amount remaining after that subtraction and divide it by 1,229,000,000 common shares outstanding. And that gives us an EPS, or earnings per share, of $6.45 per share. Now, what finance people often look at is how equity financing affects earnings per share. There are 3 main ways to finance an asset purchase. The first way we can finance with retained earnings. It means we're just going to be using what we have in cash, buy it, no borrowing. We're simply going to use what we got and make the payment. We can issue equity, meaning we're going to sell some stock. And when we sell stock, we take that money in and then use it to buy the asset. This is also considered to be less risky to the issuing corporation because we're not going into debt, but yet we're still issuing out stocks, so we're finding a way to finance it, meaning we don't have enough cash ourselves to make that purchase, so we sell more stock. But when we do this, the EPS and the percentage of ownership control is diluted. So in other words, we have more shares outstanding. That's definitely going to impact the EPS. It's going to dilute it. It's going to make it smaller. So most investors are going to be looking for a higher EPS. And the third option is the issuing bonds or notes payable. We can borrow money to purchase those assets. Now, this is favorable in the context of how EPS is computed. It does not dilute the control of the corporation. And so that would result in a higher EPS compared to issuing stock. However, it also increases the risk of the company by creating more debt. So here's an example of how the EPS will be impacted by the different ways of financing the purchase of assets. So suppose Home Depot needs $500 million to expand its operations. Assume that Home Depot has net income of $300 million and 100 million shares of common stock outstanding. Management is considering two financing plans for this purchase of assets. It's plan number one, issue 500 million of 6% bonds payable, or plan two, issue 50 million shares of common stock for 500 million. So under the two different plans, one is to borrow 500 million at 6%, and the other is to issue 50 million shares. Under the two plans, net income doesn't change. That's going to be remaining the same. The expected or project income before interest and income tax is 200 million, so that remains the same. Doesn't matter how we look at this in terms of the income from the project. Under plan one, we're borrowing money, therefore we can expect to pay interest. So $500 million multiplied by 6%, meaning we're going to pay $30 million in interest. And interest is an expense, so that's going to lower income. So we're going to take the $200 million and subtract 30 million, and that means our project income before taxes will be $170 million. Now, when we compare this to the plan two is the issuance of common stock. There is no interest expense, so that is zero. So the income is going to remain 200 million. Now, as a result of this, we're then going to pay income tax expense of 40%. So we'll pay it on the $170 million of net income. That's going to mean that we're going to pay $68 million in taxes. That means that our expected project net income is going to be $102 million. And then when we add that to the 300 million that we're already expecting, our total for plan one is $402 million. Now, interestingly enough, we don't deduct for interest expense here. However, because our income is higher as compared to the issuance of debt, then we're going to end up paying more in taxes. So 68 million was paid in taxes under plan one, but 80 million is going to be paid under plan two because we're taking the 200 million and multiplying it times the 40%. So 80 million. Now, even after that, we're still going to end up with more income of 120,000 compared to plan one. Even after that, plan two for issuing common stock shares is still going to end up with more income as compared to the plan one where we're issuing bonds or debt. We end up with $120 million under plan two. We only ended up with $102 million under plan one. So therefore, the total company net income is actually higher under plan two But here again, we have to compare that to the number of shares outstanding. Well, under Plan 1, we only have 100 million shares outstanding because we didn't increase it. We didn't sell any more shares. So therefore, we're going to take the $402 million and divide that by 100 million shares, and that's going to give us an EPS of $4.02. The EPS under Plan 2, though, is higher income, but we have a significant more number of shares outstanding, 150 million shares. So therefore, our earnings per share is going to drop to $2.80. So naturally, management might be inclined to go with Plan 1 to borrow the funds and end up with a higher EPS as a result. We can look at market capitalization and price earnings ratio. A company's market value or market capitalization is really the market price multiplied by the number of shares outstanding. So the overall market assessment of the worth of a share of a common stock is reflected in the price earnings ratio. The market price is reflected by the stock's price earnings PE, price earnings ratio, or multiple. So the price earnings ratio will be equal to the market price of one share of common stock divided by the earnings per share of common stock. So the price earnings ratio is something that is often looked at by investors to determine whether they like this. And again, the number by itself is almost meaningless. You have to compare it to others in the same industry to really come up with some thoughts as to whether it's good or bad. We also like to look at dividend yield. If an investor is looking for money to be paid to them, maybe it's one that's looking for some type of fixed income dollar amounts. Let's say if you're retired and you're just looking for cash flow, then you're going to want to invest in a company that has a pretty high dividend yield. And the way we compute that is we take the dividends per share of common stock, the dividend per share of common stock, that's what's paid out to, on average, to shareholders, divided by the market price per share. A higher dividend yield suggests that this company pays out more in dividends, and if that's what you're looking for, you may be inclined to invest in that type of company. Finally, we're going to look at the learning objective 10.6, and that is the impact on the statement of cash flows. Whenever we're talking about equity, we're always talking about financing activities because the company is dealing with its owners. There are three main categories: the issuance of stock, there's treasury stock, and dividends. So here we're looking at the activities related to stockholders' equity. This could be the cash flows from financing activities. These could be examples of what you might see related to the equity section. You would have repurchases of common stock. That would be a negative cash flow because the company is actually buying common stock. So that would be negative to cash flow. Money is leaving the organization. Proceeds from the sale of common stock, that would be positive inflow. So you would see a positive number. And then cash dividends paid to stockholders would be a negative amount too. That's money paid out to stockholders. Here's a consolidated statement of stockholders' equity, looking kind of a comprehensive view of all the items we've already discussed. You can study that. Here's a stockholders' equities example of a company referred to as General Teaching. Here's the stockholders' equity section that is represented in two manners, and you can see how they're related. And then you have some general guidelines to understand financial statements, and you could read through those at your leisure. That completes Chapter 10.